Hello students, today I am going to start a session on corporate accounting, which is an advanced part of Basics of Accounting 1 and Basics of Accounting 2. Already you have learnt Basics of Accounting 1 and Basics of Accounting 2 in your first and second semester. It's just an advanced part of whatever you have learnt in these 2 semesters. So I'll be starting with the company accounts, where I'm taking as a issue of share capital as my first chapter to discuss. So let us discuss upon issue of shares. First of all, let us know what is the meaning of company. See, company is a voluntary association of persons created by law having a share capital divided into number of shares, which is created for the common purpose to be achieved, right? So this is what we call it as company. Now, what are the features of company? What are the characteristics of a company? Let us throw a light upon that. See, company is a separate legal entity. So, members of a company quite distinct from the company itself. We are separating the company from its members. So, any act of company will not represent its members, or any act of members will not represent the company. Next feature, if I can throw a light upon, liability of the members are limited. A company, if it is a public company, is having a limited liability. So, by this feature, if the company has a limited liability, the risk of the shareholders or the burden of the shareholders are quite less. They are only liable to the company only to the extent of share held by them. Third one, it has a perpetual succession. So what is the meaning of perpetual succession? Perpetual succession means it has a continuous existence or the continuous life. It is always said that members may come, members may go, but the company remains forever. So with the feature of perpetual succession or the continuous existence only, company can plan for tomorrow. It is same to the individual life also. If we are not believing that tomorrow is existing, we are not planning for tomorrow. Same to the company as it is. If the company believes that that is going to operate in the tomorrow, then only it plans for the future, then only it creates the assignments for the future. The fourth feature of the company is the shares of the company can be freely transferable. So suppose if one member of a company doesn't want to be a part of the company, in such a case he can step out from the company by selling his shares to the other members. So that's why shares of the company can be freely transferable from one person to another person. If one person doesn't want to be a member of the company, in such a case he can sell the shares of that company and can step out from that organization. A company is a legal person created by law. It has a separate existence. When the status of legal person when it is given from the side of the company, it can sue anyone, or if anyone sues the company, that can also be possible, or it can purchase the assets, or it can dispose the assets in its name. So status of legal person is given to the company. Company is a voluntary association of persons created for the profit. The ultimate aim of the company is for the profit. And it has a common sale because it doesn't have any hands to sign by itself. So it has a common seal through which we can come into recognition that company is in existence. Let us go for the kinds of the companies. What are the kinds of the companies are there in the society? So from the point of view of formation, the companies are divided into 3 categories. One is chartered companies, second one is statutory companies, third one is registered companies. Chartered companies came into existence by the special act of charter, which is ruled by king or queen, is called as chartered company. Say for example, East India Company is one of the chartered company which was present in the earlier era. Second one is statutory companies. Statutory companies are the companies which came into existence by the special act of statute. RBI, for example, is one of the statutory company. Third category is registered companies. Registered companies are companies which are registered under Companies Act 1956. Or if it is registered under any former act, it is also considered as registered companies. From the point of view of liability, the companies are divided into companies limited by shares, companies limited by guarantee, unlimited companies. Companies limited by shares are the companies which are giving a limited liability towards the shareholders. The shareholders of the companies are having a limited liability towards their company. So it reduces the burden of the shareholders when certain persons are subscribing to the shares of a company limited by shares. One more classification is classification of companies limited by guarantee. So companies limited by guarantee are the companies where the shareholders of the companies at the time of winding up of the company are providing a guarantee that to a certain percentage of losses they are representable or they are liable. Third one is unlimited companies. Unlimited companies are the companies where the liability is unlimited. The burden of shareholders are unlimited in such companies. So if any risk happens for the company, if any loss happens for the company, shareholders has to take all the risk which are happening to them. So they cannot stick upon certain proportion or certain percentage of risk. All the risk, if it is equally, that has to be taken by the shareholders in the case of unlimited companies. Let us classify the company on the basis of number of members. On the basis of number of members, companies can be classified into public company and private company. See, public company is a company which issues the shares to the public and which doesn't restrict its membership limit. So any number of members can come and subscribe to the shares of the public company. Public company will have a paid up capital of rupees 5 lakh. At least it should have the paid up capital of 5 lakh. When it comes to the private company, private companies will not issue the shares to the public. So in a brief meaning, we can tell that private company is a company which is not issuing the shares to the public. Private company will have minimum number for at least 2 and the maximum numbers of members are restricted to 50, and it cannot transfer the shares to the public. Next, we'll discuss upon the share capital of a company. What is share capital? Company being an artificial person cannot create its own capital. It has to depend upon others or its members in order to bring the capital. So that's why it issues the shares to the public, and from the public money, the operations of the company is possible. So share capital is the total amount of capital collected from the shareholders, and it acts as a major investment in a running of the business. So when it comes to the categories of the share capital are divided into 5 parts. First one is authorized capital, second one is issued capital, third one subscribed capital, fourth one called up capital, fifth one paid up capital. First one, authorized capital. Authorized capital is the maximum amount of capital that can be collected by the company in its lifetime. In the constitution of company, if the prescription of the authorized capital is made into the certain limit, they cannot exceed the authorized capital in a later phases. If in the memorandum of association as well as articles of association, some limit has been specified about the authorized capital of the company, in the later phases it cannot be altered in a very easy manner. So that's why while fixing the authorized capital of a company, the company must be very careful. Second one is issued capital. Issued capital is that part of authorized capital which has been actually issued to the public. Suppose if the authorized capital of a company is 10 lakh, a company can issue 9.9 lakhs to the public, because they are having a specified limit which has been prescribed in the memorandum of association as well as articles of association. Third category is subscribed capital. Subscribed capital is that part of issued capital which has been actually subscribed by the public. It is not mandatory that all the amount of issued capital has been subscribed by the public. Suppose if I can consider the example of product, if a company gives or markets 10,000 products, it doesn't mean that each 10,000 product has been purchased by the purchasers. It depends on the image of the company, or it depends on the prestige of the company. Based on the image and prestige of the company, the subscription of the shares are happening. But according to the Companies Act 1956, in order to run operations of a business, it is mandatory that minimum 90% of the subscription has to be met by the company. Fourth category is a called up capital. Called up capital is that part of subscribed capital which has been actually called up by the company. For calling up the capital by the company gives 3 to 4 installments to its shareholders. That installments are called as application money, allotment money, call money, or share call money. So you are getting an opportunity of the utilization of installment in paying the capital to the company. Because when you have subscribed to the huge amount of capital like 1 crore, it cannot be possible for a member to pay all the amount of 1 crore in a one installment. So as a case, in such a case, the company will give the installment, and a member can, or the shareholder can, use the benefit of installment to give the amount of capital and to become an owner of the company. And the last category is paid up capital. Paid up capital is that part of called up capital which has been actually paid by the shareholders. It doesn't mandatory that each shareholder pays all the money which is due from him. Sometimes people subscribe to the shares and forget to pay the money to the company. So as such a case, there will be a calls in arrears, and when there is a calls in arrears, the company forfeits the shareholders given shares. So these are the categories of the share capital which are discussed in brief. Next, what are the nature and classes of shares? As you all know, shares are the fraction or the part of the total capital of the company. It's just a small part in the total capital of a company. So total capital of a company is divided into small fractions, small shares, and it is distributed among the members. There are two classifications for the shares of a company. That is, one, preference shares, second one, equity shares. Preference shares are shares which are having a preferential rights over the payment of amount of capital as well as payment of amount of dividend. If you are subscribed to the shares of or preference shares of a company, in such a case you are getting a preferential rights over equity shareholders with regard to getting of capital as well as with regard to getting of dividend. Second one is equity shares. Equity shares are those shares which are having ownership rights. If you subscribe to the equity shares of a company, you become the owner of a company and you are also having the voting rights. But risk regarding the equity shares are quite high because you are not getting a preferential rights as the preference shareholders are getting. So these are the nature and classes of shares. Let us discuss the issue of shares, the stages in issue of shares. As I said earlier, the stages in shares, issue of shares are classified into 3 categories. The companies are giving a installment facility to the members who are subscribing to the shares of a company. The phases of the shares issue can be classified into 3 stages. One is application stage, second one is allotment stage, third one is call stage. Application stage is that stage where you are going to give the applications to the shareholders, and in the allotment stage you are allotting the shares and you are making the first and final call in order to get the money to the organization. If particular person subscribes to the 10,000 amount of shares, he is given with the opportunity to going through the installment, like you pay first installment at rupees 2,000, second installment at rupees 4,000, third installment at rupees again 2,000. Thereby your claims to the organization is settled in the application stage, allotment stage and call stage. And the next one is journal entries or the accounting treatment for the purpose of passing the entries. So how we are passing the entries in the case of application stage, in the case of allotment stage as well as in the case of call stage. So first journal entry is for collecting the application money. See, application money is collected and the amount of cash comes into the organization, and the journal entry to be passed for the collection of application money is bank account debtor to share application account. But students, share application account is a temporary account which has to be removed, and the application money has to be transferred to the share capital. So there requires a transfer of application money to the share capital account by passing the entry called share application account debtor to share capital account. In the earlier phase, share application account was credited. Now you are debiting the share application account and you are cancelling both the share application account by passing one debit and one credit entries. And you are transferring all the money into share capital account, and thereby you are raising the amount of share capital. Let us go for the refund of money. What if refund of money happens in the case of rejection of application? See, if there is a rejection of application, money will go outside and amount of money has to be given to the members or the shareholders. So the journal entry that has to be passed is share application account debtor to bank account. So the money goes out of, that's why bank account is credited. Second stage is allotment stage. So what is the entry due for the allotment? Let us consider the entry share allotment account debtor to share capital account. You are making the remember to the shareholders, that is allotment money is due from your side. So this is the entry for allotment of the shares due, and entry for the receipt of the allotment money is bank account debit to share allotment account. Again you are cancelling the allotment account. Why? Because it's a temporary account and you are increasing the share capital. Third entry is for call money due. Again same kind of entry you are passing. First of all you are making a due entry, then you are passing the collection entry. For making a due entry, you are passing the entry called share call account debtor to share capital account, and you are raising the capital, and you are making them to remember that on their part certain amount of money is due. So in the third installment, share call account debtor to share capital account. Again this share call account is a temporary account that has to be removed by passing a credit entry. For that we are making one more entry, bank account debtor to share call account for the receipt of call money in the organization. So these are the entries we are going to pass in the case of stages of receipt of shares to the company. I hope these entries are very easy for you to understand. I'll complete this session here itself and let us discuss some practical problems in the next session. Thank you.